All right, testing 1, 2, 3. Hopefully everybody can hear me. Let's see. La -di -da -di -da, da -da 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 -da. Let's see if we have anything. All righty. Looks like everything's good to go now. Oh, so I'm tired. I'm already tired. Let's see. Where's my freaking tea? There it is. Now we're ready to go. Gotta have something to drink. So hello, anybody out there, please acknowledge that you can actually hear something so that it's worth moving forward. Maybe nobody is out there. Or maybe nobody can hear me. One of those two things. Either one is possible. Let's see how everything's going. That's not the Dow. That's the Dow. Nope, it's not the Dow either. Well, I'm amusing myself anyway. All right, now we're getting some replies. All right, so now we're going to try to see if you guys can see the screen. The screen, people can see your screen. It says people can see my screen, so when you can see my screen, let me know, and we can get this show on the road officially. All right. How's everything going? How's oil? Oil fell. Oh, that even went lower. Gold and silver, not so bad. I can see you. Oh, Clay says he can see me. Uh-oh. Shouldn't be able to see me. Should be able to see my screen. But we'll take that as an affirmative. And we will move on to the next step where we have the reading of the notes. Oh no. Gonna reset that. Control C. Okay, there we go. And play.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade, not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. So let's see. Where are we? Need to get to that right now. Oh, I know. Let's see if we can get the oil report up. That was interesting. So, October 1st. Oh, sorry. Tired today. I don't know why. Plus. So what happened to oil? Oil reserves, including blah, 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 increased by 2.3 million barrels, and gasoline went up 3.3 million barrels, and distillates were down by 0.4. So on the whole, you got a 5.1 million barrel build, and that's very disappointing for the oil bulls who were telling you how much more demand there is and so on and so forth. And like we said last week, or when we were talking about, there's no evidence of this. I mean, yeah, there's more demand than last year, but last year we were locked down. But all we did is go from 17.8 last year to 20.8, or not even 0.8 this year. So 10%, well, almost a 20% increase in demand, but that's only back to your 2019 normal levels. It's not like it's a special thing. There's not any kind of huge upsides in demand. And meanwhile, we're the products supplied, well, you'd say demand, but the products supplied are coming in the same. What's happening here, look at petroleum products. We're importing, or we're exporting, sorry, we're exporting less. We were exporting 3 million barrels. Now we're exporting 2.1 million barrels. So we're exporting a bit less. I don't know what the reason is for demand or so on and so forth. Look how different this number is too. Look what was last week. Last week it was 109, and now it's 1712, and that's per day. So that's a massive jump. So our input, so we're bringing 3.8 million barrels, we're exporting 2 million barrels, and we're keeping 1.7 million barrels. So we're actually net importing. We used to be net exporting, and now we're net importing. On the whole, we have no net change though, because other oils picked up. So there's no net change in inventories really. Oh no, haven't picked up. Why is that the same number? I'm sorry, hang on a second. If this is, all other oils was 62, it went down to 58. That's a big drop. Oil went up from 18.5 to 209. Gasoline went up from 221 to 225. And other oils dropped by 4. That's why. So the other oils dropped by 4 million barrels and offset it. So honestly, the draw is not as big as you think, or the build isn't as big as you think, because in this case, all other oils went lower. Usually we say, oh, all other oils went higher and they hid the oil. Now the drop has been hidden in all other oils. So they have taken it out of inventory. So yeah, I wouldn't call it super bullish or super bearish. It's a pretty neutral report, but of course we were gearing up for some kind of show of demand, and it's really not there though. You're not seeing any kind of big boost in demand. And that's what Goldman Sachs had been claiming is happening. And meanwhile, look at the input to refineries has gone up substantially too. It went up from 14.8 to 15.2, more oil coming into refineries are coming back online. Remember the hurricane? So we had 84.9% last week, which is still more, last year, 75.9. 1/4 of the refineries were shut down last year. Now, only about 15% is shut down. And the numbers are very similar. So, I mean, there's no great changes. There's no great anything. There's nothing that justifies this kind of price. But last year, the price was $36.90. And now it's 76. It's crazy. So anyway, we had played oil short. Where is our active trader? We had played oil short, but I called it off at 77.50 earlier. I said the hell with it, because it wasn't worth it. Coming into inventories, we didn't know which way it was going to go, and we had a really nice profit, 57. That's profit for the day. It was actually more like 6,000, but it's about $6,000 at 77.50 from where we came in. So why would we not take that off the table? It doesn't make any sense to risk it at that point. We didn't mind risking it when we were up here at 79.50. That was when we wanted to risk it. I'm not going to risk it after we make all that money. After you make $2 a contract, You don't want to risk it. That's where we are on the energy stuff. On the market overall, we're just, well, we're not. I mean, we're down 250 here, we're down 28 here. But in the bigger picture, futures charts, indexes. So on the, from the daily perspective, we've been heading down since September. The whole month of September, all the way down. We haven't improved. We came down there, we bounced, and now we're back to the lows that we had in September, lower than the low in September, much lower than the low in September, and a little bit higher than the low in September here. But we are moving in a very downward path. This is a slow but sure meltdown for the market right now. And you know, when you're in this sort of thing, you have to say, well, what's going to turn it around? In fact, speaking of which, we should have said that about who was it? We just put the money on Moderna, mRNA. So we played for the bounce here. We got a little bit of a bounce, and now it's back down. You gotta be patient. We sold the 200 put, so I'm not worried. But I mean, we took a position in mRNA and sold the 200 puts, and we felt we got a good price. But now it bounced, and now it's coming back down, and maybe it'll go lower, especially if the whole market's dragging it down. Got to be careful about these things. But you know, we didn't mind because it was just we sold 5 puts for $12.50. And that wasn't terrible, but I'm just saying you got to be careful about calling the bottom. And you know, rather than try to call a bottom and guess where the bottom is, you got to let the bottom show itself to you and prove that it's a bottom. So for example, well, they can't say for example because none of these are really bottoming yet. So that's not a good example. But you know, these are, you know, weekly charts. And you look at them. And that's the other thing, by the way. Look at the monthly charts. And the monthly chart and the weekly chart, these corrections are nothing. You say, you know, you look at this and you go, oh my God, look at this big correction. It's nothing. We're in the very, very beginning of a proper correction. Okay, and they're called a correction not because you're going to go back to where you were. It's correction because it's going back to the correct price. The incorrection is here. This was incorrect, 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 incorrect. The correction is going back to a more sustainable path. And on the S&P, you can see a reasonable growth path is like this. Maybe 4,000, but like I said, I'm shooting for 3750, maybe 4,000, but certainly not all of a sudden curving up. It doesn't make sense because your economy doesn't grow that way. You know, we have, you know, if the GDP was growing at that kind of rate, great, but you're talking about going from 2,000 to 4,000 in 5 years. That's 20% a year growth in an economy that clearly has been growing. Well, if you don't count any downturn of 2020, an economy that grows at 4% a year, basically, not even 4% a year. But let's say we even grow 4% a year. How do you justify 20% growth in stock valuations when your economy is only growing 4%? Makes no sense. You got to be realistic about how much you're actually growing. So you say compound 4%. Maybe that over 5 years you can justify 30%, 40%. Maybe you can justify, not 100%. And so everything above 40% is pretty much, and 40% would be 2,800, by the way, but anything above 40% just means you're paying a higher valuation for the stocks. You're now paying a much higher PE ratio than we used to be willing to pay in 2017. And you can say, okay, well, that's a new normal. Why are we paying the higher PE ratio? We're paying the higher PE ratio because the alternatives now suck. You have a choice of what are you going to do with your money? You're going to put it in the bank, you're going to put it in stocks, you're going to put it in bonds, you're going to put it in housing. right? Not too many choices. You know, you can invest in private business or whatever, but it's still kind of like stock. So, you know, it's stocks, bonds, banks, cash, housing. So inflation makes cash a bad bet. Inflation makes bonds a bad bet. They're not paying you enough. Housing, everybody got burned on in 2009. In 2008, everybody got burned on housing. So it's hard to get people really excited about housing, about putting money in housing. All that flipping and crap that we used to do doesn't really exist anymore. And that leaves the stock market. And the Fed's fine as long as it keeps going up. You know, we've had some pretty solid up years. It's been going up since, well, how long has it really been going up? It's been going straight up since 2009. Up, I mean, you know, not 100% up, but up and up and up. It's been the best thing to put your money in by far. You know, if you bought a house for $1 million in 2009, it ain't $4.5 million now, is it? And obviously a bond didn't pay you that much, so there is no other class of investing that is paying you this much. But that doesn't mean that you're not being overpaid or haven't been overpaid. And you cannot assume you will continue to be overpaid. In fact, it leads you to believe that maybe in the future you will be underpaid until it evens out. So, you know, this is just not normal, not reasonable, not possible to keep going at this rate. You know, here's let's take a look at US GDP by year. Minus 3.5% last year, minus 3.5% GDP, yet the market went up tremendously. Forecast GDP growth rate, here you go. Or it doesn't give you an absolute number. See, that's annoying. US GDP by year. Oh, what's that? And where is it saying about this P ratio of the S&P? That's interesting. All right, anyway. So the bottom line is in 2009, the GDP was $15.8 trillion, $15 trillion. It was 15 trillion in 2006, it was 15 trillion in 2005, it was 15 trillion in 2010. So not particular growth, but it was 15 trillion. Now, since then, the GDP has gone up from 15 trillion to 19 trillion. All right, it was 15.8, so I'm not going to say it's 20. It's 15.8 trillion. All right, to currently it's 19.3 trillion. Now, also don't forget though that some of this stuff is inflation. You know, it's just price inflation is causing the GDP to go up, not just, so a dollar isn't a dollar anymore. It's not the same thing, but it doesn't matter. The point is 4 divided by 15, right? So it's going to be, what's exactly what I just said? 4 divided by 15 is 26%. It's not even 40%, it's 26%. So 26% since 2009 is how much the economy has grown. Yet you are paying since 2009 300% more for stocks. So 10 times. The stock market is going up 10 times faster than the economy is growing. It's not sustainable. How can it be sustainable? Now, it may not be as dire as you think, because not as dire. It's not as bad as that, because stocks are making more and more of their money from overseas. So the US market is taking a bigger share of the global pie and making more money overseas. In fact, they now make most of their money overseas on the S&P 500. You could also argue that the S&P 500 is not fully representative of all stocks. So in other words, these are the best of the best stocks in the S&P 500. And so they're making a bit more. But then the problem is, of course, I mean, and obviously, I mean, you guys know that the earnings aren't keeping up. The earnings are great, but they're not 350% higher, 300+% higher than they were. That's just not, it's not a thing. So there's no other logical thing to say other than stocks are overpriced. So the main point about that is, though, it doesn't mean that something's a bargain just because it pulled back, because you can't assume that it's going to go back here. This is, you know, what a 100-year flood zone is, right? Like the flood, you know, you have a flood, there's a floodplain, and the government will say something floods once in 100 years or once in 500 years, something, you know, it's not that it never floods, but it floods so rarely that you don't have to worry about it. So there's 100-year flood zones and 500-year flood zones. And if you're in a 500-year flood zone, you basically ignore the concept of it flooding. It's just basically impossible for it to flood. You're going back to Noah pretty much from the last time something flooded. That's what this is. It's not. It's like a flood. It's just such a rare occurrence that you cannot count on it being repeated. Just because it did happen doesn't mean you should bet it's going to happen again. People just can't pay these crazy amounts for stocks. Now, they're fundamentally sound stocks, and we keep buying them, like Moderna, which we just put money into. They are fundamentally sound stocks that are good to buy, that have a great future, great growth potential, so on and so forth. Now, they will pull back with the rest of the market. So they're going to be the baby gets thrown out with the bathwater. In other words, they're perfectly good stocks. Apple's another good stock. There's no reason to sell Apple. Even if the market pulls back, Apple will eventually come back to the top. But you can't just take any stock that randomly goes down and decide that, oh, I'm going to buy that because the market went down. It doesn't mean you're going to come back to this level, because this level is not natural. It doesn't make any sense. So I'm assuming we're going to have stimulus, and I'm assuming that we're going to have more stimulus, and I'm assuming the Fed is going to keep a fairly easy policy, and so on and so forth. I'm saying 3750 is fair in that case. This is ridiculous in any case. There's no case in which you can justify this. 3750 with stimulus, I can justify that, but not 4500. That's just way too far, and obviously it's 30% above 3750. So we're just looking for a little bit of a pullback to 3750. And that's when I'm going to start just generally being happy about the S&P 500. Still going to be very selective about what we buy, but we're going to look for it. But we're a long way from there. This is only so far 1/3, excuse me, 1/3 of a correction, because 3750 is here. So 3750 is back to the trend where we finished up last year. So all of this year is going to get erased, is what I predict. And that so far we're about 1/3 of the way there, and then another drop, and then one more drop, and we'll be there. So we have to be patient. Just can't just go jumping in, and certainly don't go just because some stock you're looking at got cheaper doesn't mean it's fairly priced. You still got to look at it and say, you know, would I buy this? Would I buy this based on the fact that I couldn't buy it before? So like I said, here's Moderna. Did pull back, but we didn't jump in because it pulled back to 315. We pulled back because the 200 puts were 1250. So I don't know what they are now, but they're probably about the same. So the 2024 200 puts. Oh, I'm sorry. Were they? Oh, I'm sorry. They were 25. That's right. We sold them 25. They're more than 25 now. So we sold them the other day for 25. Now they're like $27, $28. So we're losing money on them. But our net entry is 175. Okay, so that's where so the point of this is it wasn't that it went to 300, it's that we could say, okay, we'll buy them at 175. At 175, I'm very comfortable with that price. If you've got questions, no questions, very good. I'm doing great. All right. Let's see what we talked about today. Okay, so today we were discussing, we have this oil play. Hey, you know what? This morning we were still at 78.07 this morning, and I said we were going to drop to 77.50. So we got that, so that's very nice. So even if you came in late, you could have played that because we were only up 4,000 at the time. We ended up 6,000. Oh no, I'm sorry. The profit and loss was 3,000. So the P&L for the day was 3,400, and now it's like, and we ended up at let's see where we ended up. We ended up with 57. So that tacked on $2,000 more or $500 per contract from the morning post. That's very nice. You know, but that was easy because yesterday, I'm sorry that we did this yesterday. Yesterday we got up to here, and we wanted to play it short. And so yesterday I ended up picking up 4 shorts at 79.08, and we rode it out overnight. I don't want to say we rode it out overnight. I was sleeping. I was like, I wasn't watching this and deciding I was going to stick with it. This was like really early in the morning, and we just didn't bother. You know, I just didn't wake up and start selling. You know, 3 o'clock in the morning, but it was nonsense. You know, so that's the thing. I mean, if you're gonna freak out because something goes against you at 3 o'clock in the morning, don't play the futures because, you know, with that kind of volume, with 2 or 3 contracts trading at any given time, even now, 4 contracts, 8 contracts, 9 contracts, 17 contracts. This is not heavy volume, so prices can fluctuate very, very, very quickly. And you have to have the conviction to ride something out. That's really what the problem is. I mean, my attitude is basically if it goes up to 80 again, we're going to be just doubling down. And frankly, had I been awake for that, I probably would have just added more contracts. But then again, hitting the goal. See, now we have $6,000 profit, basically $5,700 profit. So the next time I play, I'll be a little bit looser. I'll be less worried. We got a cushion. Oh, look at the markets coming back all of a sudden too. I wonder if somebody said something. I don't think there's any particular news. So we talked about the API, and there was a build, and the build was 3.7 gasoline, 2.5 distillate, and 951 oil. So that was a bigger build than we had in the EIA. And so the EIA only showed about a 5 million barrel draw. This is more like 6.2, 7, about 7 million barrel, 7 million barrel build versus a 5 million barrel build that we have in the actual EIA. So it's actually not as bad as they thought, which is why, again, there's no reason to keep playing it at the moment. And talked about the inflation and the revenues. You just got to realize what's going on here. I mean, we're just borrowing we're borrowing $250 billion per month in the budget. And why is that? Because look at the budget. We have 3.4 trillion in revenues. We have 6.6 trillion in spending. That's 3.2 trillion short. This is math. This is the current budget that we're working on. And of the discretionary, defense is 714 billion. That does not count. That doesn't count the defense that's included in, there's Veterans Affairs is a couple of $100 million. That's not included in this defense, but it's also part of discretionary. And then you've got your veterans, the benefits that go to the Army, so security payments for defense, Medicare expenses for defense people. You know, they retire and they have a part of that budget too. So defense spending is well over $1 trillion in the U.S. or various forms of military spending. There's military education. There's military budgets in all parts of the other non-defense GDP. But this is some scary shit because our whole discretionary budget is $1.6 trillion and we're $3 trillion in debt, 3.2. That's non-discretionary debt. We can't get out of this even if we shut down everything, even if we shut the military and shut every single department in the government. We still have a $1.6 trillion deficit. But then how would we collect the money? If we shut down the whole government, how are we going to collect the money? Look at corporate taxes. Corporate taxes, $212 billion. Out of all the money we collect, corporations pay $212 billion out of $3.4 trillion. This is entirely what's wrong with the country. Corporate taxes are $212. That's sick. We almost don't tax corporations. There's basically effectively no tax on corporate profit. And that's why we have the deficit. Started with Reagan way back. This has been going on that long, and it's gotten worse and worse and worse. And Trump just lowered corporate taxes tremendously. And if you're undertaxing the corporations for 40 years at a couple of $100 billion a year, or more like $400 or $500 billion a year undertaxed. But let's just say it's a couple of $100 billion a year undertaxed for 40 years. That's $8 trillion. So we're basically, the deficit is made up of undertaxing corporations. Realistically, probably $16 trillion. Most of our deficit is made up because of the fact that we undertax corporations. And in fact, obviously, if we did tax the corporations, we wouldn't have run the deficit. Then we wouldn't have all the debt level, the debt spending and the interest spending on the debt that we have, which has also added. Obviously, we spend 30% of the cost of all goods and services consumed in this country to the entire GDP. There would always be a 30%, but there'd be no exemptions, no taking off, no nothing. So everything so you would pay no taxes, not even Social Security, everything would be free, but 30% VAT. And that's painful. A 20% VAT is pretty normal, though. Right? I mean, they have that in most countries. So, and if we weren't doing this massive additional spending, we would be able to manage on oh, in fact, there it says 4.6 trillion mandatory spending. If we hadn't been spending, where do they get 4.6 trillion mandatory? Oh, here, because the paycheck, they're including the paycheck protection, the extra unemployment, so on and so forth. But the bottom, oh, here's the interest. Sorry, it's 345 billion. That's what we're paying for interest on the debt. So, you know, I mean, the budget used to be $4 trillion. Now it's 6.6. I'm pretty sure that's because of the stimulus. I certainly hope so. And if you take that away, we could hopefully get back down to 4 trillion. If it's 4 trillion and we did a VAT, then you would just pay 20% tax on everything you pay. And we'd have a balanced budget, and you wouldn't have to pay any income tax at all. Now, you could say, well, what about people who are super rich? Could we tax them more? Sure. We could collect another trillion or so towards paying down the debt by having a surtax on top of that, so that only people, or in fact what Biden wants to do, only people making over $400,000 a year pay tax. Everybody below $400,000 a year pays nothing. No, not even payroll taxes, nothing. But everybody pays a 20% tax on everything they buy. And that would balance the budget. Done. That would balance the budget. Nobody would be able to cheat. You wouldn't need the IRS, or except for collecting from the rich people. You could have a surcharge on corporations to make a certain amount of money too. If you do it to corporations, they're just going to move the money around anyway. You know, like if you say corporations over $1 billion pay a tax, all they'll do is break the corporations down into a bunch of companies that make less than $1 billion. So you're never going to catch those guys. They'll pull every trick in the book. But this is crazy. To say you can't possibly balance the budget is one thing, but the reality is, though, without radically changing everything we do, this budget can't be paid. You can't reconcile this. You can't reconcile that you're 6.6 trillion in spending and 3.4 trillion in revenues. You either have to double your tax or cut your spending in half. So, you know, when you say, oh, that would be painful to pay 30% tax on everything you buy, well, it's going to be painful as shit if they double your taxes too. So are we ever going to take balancing the budget seriously, or just going to keep going like this? And we can't just keep going like this, because $345 billion in revenue with 30 trillion in debt. This is only 1%. We're only paying 1% interest. If we had to pay right now in China, property companies are paying 17%. I wrote about that today. So in China, there's another default. So now the property companies are paying an average of 17% interest on their debt that they're issuing now. That's a Greece problem. That's what happened in Greece. All of a sudden, they used to be able to write notes for 6%, 8%, and now they got to roll them over at 17%. Of course, they're all going to go bankrupt. Of course, they're all going to tumble like dominoes. Because like America, every time a note comes due, we don't pay it off. If we paid it off, the debt wouldn't be going up. If we, instead of paying it off, we just issue another note. And as long as the other note is still at a low interest rate, it doesn't make a difference, right? All we're doing is continuing to pay the interest, which is still $345 billion a year. But that's against $30 trillion in debt. Now, if interest rates go up to 2%, it'll be another $345 billion. If it goes up to 3%, it's going to be $1 trillion in just interest payments, and that's going to add another 600 billion to this number, because it already includes this 345. And then at 4%, obviously, it's an extra $1 trillion of spending that we'd have to be doing. We'd go an extra trillion in debt. It's hopeless. And that's the thing. That's how it gets out of control so fast. Because when you get to 4% debt, I'm sorry, 4% interest on the debt, and now our budget says we're going another $1 trillion into debt this year on just making the interest payments on our debt. Well, then all the lenders look at you and say, well, I'm not lending you money at 4% if you're going this fast into debt. You're going another $1 trillion into debt. That's 5% of your GDP. Another 5% of your GDP into debt every year just to pay the interest on the debt you already have. And you're doing nothing to pay down your debt. And you're doing nothing to balance your budget. And your budget, by the way, is still out of whack by $1 trillion a year. So you're going 10% of your GDP into debt every year, and you're paying an interest on that debt. That's what we're staring down the barrel of that gun right now. And so when you're in that situation, are people still going to lend you money at 4%? No. So that's where this gets out of control so fast. And that's what the Fed is afraid of. And that's why the Fed is lying to you and telling you there's no inflation. And that's why the government is lying to you. And everybody's lying to you because the truth is unworkable. The truth will not set you free. The truth will put you in bankruptcy court, international bankruptcy. And again, is there a solution? Yeah, there is a solution. You have to realistically address this problem. You have to get the budget deficit back down to 4 trillion. It's the budget deficit. The spending has to get down to $4 trillion, and that's going to include cutting defense and cutting a lot of stuff. But you have to cut to $4 trillion. You have to get revenues up to $5 trillion. You have to do that. You have to start paying this shit down, or it'll never get paid down. And next time we have an emergency, you won't be able to borrow any more money. We just borrowed $10 trillion in the last 2 years. That's insane. And we are in an unworkable situation, and nobody wants to face it. And the point of all this is, why talk about it? Well, the point of this is, if you're a long-range investor, you got to start thinking about this shit. Look at what's going on in China. You see, we don't feel it yet, but there is a major property crisis in China. You can't do. China's growth is based on building these mega projects, and they build whole cities on spec. And that's and these companies are now getting killed. The two biggest builders who do these cities on spec are Evergrande and Fantasia, whatever they're called. Let's see, I talked about it here. What are they called? Fantasia. Yeah, they are Fantasia. So Fantasia builds cities, Evergrande builds cities. These are China's two largest builders, and they're both in default now. And part of that is a change of policy where the government was basically allowing this to happen and looking and turning the other way, and the assumption was the government would always bail them out. But the government's now saying we're not bailing out property speculators. And everybody's going, what? You're not bailing out property speculators? And it's crazy, but you know what? It's the same craziness that we used to talk about in 2005, 2006, when China had empty cities. And we used to report on these things. We said, look at this giant city completely empty. And they still have the same cities and the same empty cities. This is like 20 years later. They've never filled these cities up. So how can you do that and pay 17% interest every year on the money you borrowed to build the city? Of course you're going to go bankrupt. And the country will go bankrupt trying to save these guys. Evergrande is $300 billion in debt. I don't know what Fantasia is, but Evergrande's got $300 billion in outstanding debt. And that's not even including, so then you wrapped up with the municipalities in China too, who've lent money and created bond programs and so on and so forth, because they're building in their province these cities, and they've helped out and they've raised capital and so on and so forth. And they always do it on the assumption that if you build these things, it'll come. China builds airports, and this is China's whole GDP is based on this for the last 20 years. They build airports that nobody actually uses. They build rails, trains that nobody actually goes on. You know, they built this this fantasy country. That's why fantasia is a good word for it. But they built this fantasy country, ultra modern stuff, really good high-tech stations, great airports, blah, blah, blah. But the people don't want to go there. You can't force the people. Well, they can almost force the people, but you can't really force people to go somewhere. There has to be organic growth. You know, so in America, we just let the people go wherever they wanted, and cities sprouted up around the people. You have a natural thing. So the way the cities are connected and the rails are connected is, and of course it's a patient thing that happened over a long period of time. But then the government said, okay, well, we've got these two cities, we're going to connect them by rail. So the government says, okay, now that we have the cities, we'll build a rail, we'll build a road, blah, blah, blah. We'll build, you know, we'll help electrify things. We'll put a dam up here to supply these people, because the people wanted to be there, and the government just made life easier for the people who were already there. They didn't say we're going to build this, we're going to build a city and people will come because we're going to build a city. It doesn't work that way. Economics, human nature doesn't work that way. People move for their own reasons, and it's very, very hard to predict, and it's very hard to say this is what's going to happen here. You know, building developers have the same problem, right? Property developers, they build a property, and if they build it in the wrong place, people don't want it, and they lose their assets. China builds whole cities in the middle of nowhere and puts a high-speed rail line and an airport there and says, there you go, now people can come. But unless it grows normally, why are people going to come? Who's going to be the first person to get an apartment in an empty city? And what happens is and the prices get artificially knocked up because people speculate on the empty city apartments, thinking that down the road they'll be able to sell it when the people move in, but then nobody moves in and everybody goes. All right, and that to a large extent is a special China problem, but they're connected to the whole global financial system. So if Evergrande goes bust, it's everyone's problem, not just China's problem. And other Chinese companies are also going bust, and they're going to lose $1 trillion. And so let's say half of that money was lent by Chinese banks, but half of it wasn't. And that's a $500 billion loss that gets spread across the global banking industry. And that's a lot of frickin' money. They don't make that much money. Goldman Sachs makes $20 billion. You know, that's JP Morgan makes $20 billion. Most of these banks don't make any kind of money like that. And so how are they going to lay off those bets? That's defaults everywhere. That's what happened to us in 2008 and 2009. So, you know, you can't be complacent about this stuff because it can drag everything down. It's the same thing as 2008 and 2009. There was these cascading dominoes started falling and everything collapsed. And you have a huge liquidity crush and everything gets sold off and people start liquidating stocks to pay for something else and so on and so forth. And this is happening, and it's like, it's very bad if you ignore it and pretend it's okay. So, you know, you got to be able to know what's going on. What did we talk about yesterday? Cash flow is sexy. Tuesday we said we were going to bounce, and we bounced exactly to the 43.50 line on Tuesday, and now we're back down to 43.23. So now we're right in between. Now we're right between 43.50 and 4,300. We're at the middle zone here. And see, there's a nice pink line there to show you that we're in the middle. It's perfect. All right, but it's widening, isn't it? It's gotten pretty wide. So we have a pretty good range. We could be anywhere inside this range would be normal. So 4,300 was the previous low, and I think we, again, we're settling in the bottom half of the 42.50s thing, and we're going to probably squeeze down. And I think we're squeezing down to go pop down and go further down on the line. Hello. There we go. But this chart shows you what this chart is. as we say, support is at 37.50. That's where I said we can justify based on the current fundamental conditions, based on the assumption that there's going to be an infrastructure package, based on the assumption that there'll be the long-term spending plans of $1 trillion of stimulus, 3.5 trillion infrastructure spending package, but it's only 350 billion a year for 10 years. It's not like it's all one shot. So basically, you're looking at 1.4 trillion of short-term support on a $20 trillion economy. So therefore, it's going to be 7% boost to the GDP, which should be enough to keep us above zero. We should be able to show some growth. But the thing is, we already spent in the first half of this year. That's why we have a $6.6 trillion. That's why we have $6.6 trillion of spending in the budget. We already spent $2.2 trillion in the first quarter of this year, or in March, really, towards the second quarter. We already spent that in stimulus. That's 10% of our GDP. And yet our GDP is only growing at 6%. So without that 10% boost, we're growing at minus 4%. Minus 4% plus 10% stimulus. That's how you get to 6% GDP growth. Is it sustainable through the end of the year without the additional 1.2 trillion? And if it isn't, that means we needed $3 trillion to get to 6% GDP growth. That means 15% boost to our GDP in order to show 6% growth. And that means we're running at a negative 9% GDP without the stimulus. Then you say, well, what are we doing next year? What's our plan? Well, our plan seems to be that we're only going to have $350 billion from the infrastructure package coming in next year. And then what's going to happen to our GDP without the stimulus? So we're waiting to find that out. We're waiting to see how much damage has been done. We're waiting for the earnings, and this is why we liquidated our portfolios. We did not completely, but we took out a lot of stuff and we put ourselves mainly into cash because this is scary shit. What's the fourth quarter going to look like when we still haven't passed the stimulus package? We don't know how bad the guidance is going to be. But we do know that we already see a lot of reports of companies hurting. We see a lot of companies that are saying inflation is really eating them alive. Oh yeah, I pointed this out yesterday too. This is why we shorted. So when oil was up here yesterday, we shorted it, and the reason we shorted is I said, here's what Goldman Sachs took advantage of. Goldman Sachs made a prognostication that we're going to be having a massive spike in oil prices. But they say this at the time when oil is bottoming. Every year it does this. This is perfectly normal. Every year we generally have more inventory in the beginning of the year. Then starting around July, we start drawing down oil into the summer. And then at the end of the summer, we start building stocks back up. Oh, it's a miracle. This is just normal cycle. This is going to go back to somewhere around here in between now and May. This is a normal cycle of the oil stocks. It generally goes in this range. This is a 5-year range. It's generally in this zone all the time. So what Goldman Sachs is doing is they're timing their call for the time when it looks like we are drawing down our oil rapidly, when it looks like we're going to have severe inventory shortages or whatever. It's bullshit. It's bullshit extrapolation done by, and this is the thing. Now, how does Goldman Sachs do it? How does the investment bank do it? They always have new analysts, but the company's got a name and a reputation. So when it says a Goldman Sachs analyst says this, that's what it is. So what does Goldman Sachs do? Goldman Sachs asks 20, 30 analysts to give them reports on oil, right? And it's just the thing that it's a Chinese wall. They're not supposed to ask for a certain way. They're not supposed to say the report should be reflecting this. But what they do is they ask a whole bunch of analysts to write up a report, and the analysts all write up their own reports. They pick the one that says what they wanted to say. They didn't tell them to write the report that way, but when you ask 20 different people to write a report, some are going to be bearish, some are going to be bullish. They don't give a shit how stupid the report is. but they get to then take it out and they promote it. Then they give it to the PR people and say, here, spin that out. And this person, who's usually a kid, who's one of the newer analysts who has their own take on oil, it feels fantastic, and Goldman Sachs is going to pick him and say, oh, here you go, kid, here's your big chance, get on TV and go talk about oil and tell them your theory on oil and why it's going to peak out. Now, these are people who don't understand the cycle and whatever. So when you say, oh, how could Goldman Sachs be wrong? They're not wrong. They've got senior analysts who are telling the clients the exact opposite of what the junior analyst is telling you, but the junior analyst is the one they send out on TV to go spout their idiotic theories. And then when he's wrong, they fire that guy, and you never hear about it again. But then a year later, you'll hear Goldman Sachs analyst says this. It's just the next batch of guys that they're going to chew through. They do it all the time. This is how investment banks come out. This is why you sometimes see the same bank will come out with two different predictions, and you say, hey, what is this bullshit? You know, you're like, didn't they just say the opposite? And that's true. They do say the opposite. It's just different analysts in the same bank. And they will pick and promote whichever one suits them to tell you whatever bullshit they want to have spun that way. So, you know, you got to look at the facts for yourself. You really can't just go by somebody told you something. And Monday we talked about, well, you know, we said that we're going to start failing, and we are failing. So there you go. That's simple enough. And here's the inflation, and the inflation is terrible. Here's 1990. You know, maybe here in 1999, when the market was peaking, of course, we had this much inflation. But the cyclical inflation is cyclical, right? It goes up, it goes down, it goes up, it goes down. But acyclical, that's what you got to worry about. This is not cyclical. It's just prices increasing that will stay increased. And this has not been this bad since the 90s. And it wasn't on an upswing like this since the 80s. That's a long time. So, you know, we have, so what do we have? We have rising inflation, 40-year highs in inflation. We have a stagnating GDP that is not functional without stimulus, and that is what they call stagflation. But we also have record amounts of debt. Something is going to go wrong. There's too many things that are straining for something not to go wrong. And you don't know what it's going to be. You don't know what the event is, the straw that's going to break the camel's back. But you got to stay nimble. And I'm sorry if it's kind of boring trading in this environment, because there's not, you don't want to have a lot of action. You don't want to have your money tied up. You want to be in cash, and you want to be careful about what you're doing, because we got to be able to react. And most importantly, though, is again, it's when the market crashes and goes down. If we have a 40% drop in the market or something like that, you want to have money on the sideline so you can buy it, because it'll come back. There'll be things to buy. When IBM goes back on sale. How is IBM going? IBM probably is on sale. Yeah, no, not that great. So if IBM gets low, Disney gets low. Yeah, see, Disney's not so bad. Now Disney, we got out of at 200, but we like to get in around 150. It's not quite there yet. Nothing's quite there yet. How's AT&T doing? Still, AT&T's flatlining down there. Pfizer pulled back a bit. What? Oh, I can spell it correctly. PFE. There we go. So Pfizer pulled back a lot from the ridiculous 50. It never should have been 50. That's why we lightened up on these things at this price, but we're still perfectly happy at 42. But you gotta find the things that are really good. Oh, how's Restoration Hardware? I wonder. Oh, look at that. Restoration Hardware is pulling back a bit, but still not to the point where we want to buy it. I can't believe that price. That's insane. Who else is classic? Home Depot. Nope, too high. Oh, FedEx, FDX. There you go. All right, so there's always going to be things where you say, aha, look at that, FedEx. UPS. I gotta tell you, I like these UPS stores. It's kind of, I mean, it's basically like the post office, except they're a little bit more competent than the post office. But it's just anything you need done. They're happy to take care of it. There's really super professional people there. It's like when you go to Home Depot. I'm always impressed with Home Depot too. They got so many people who know what they're doing. And the UPS store is like that too. They totally know what they're doing. They have infinite patience. I see people all the time who have like really dumb questions, and they take care of them, and they're always nice. They do a great job. But I feel like FedEx better as a company. Although I think possibly I'm very prejudiced about FedEx, because I mean, back in the day, when I was fresh out of college in the 80s and I worked in computers, there was no question that FedEx was better than UPS. UPS, it was 50-50 whether you'd get a package. If you sent a UPS package, you needed it to be there in 2 or 3 days. It was a complete crapshoot whether or not it would actually happen. Whereas FedEx, you could count on it. FedEx, you would someone say you didn't get a package, you're like, no way, I sent it FedEx, you definitely have it. It wasn't even really a question that somebody wouldn't get a package. That was their slogan, I guess. But so $60 billion of market cap for FedEx, and they're making 5-point-something billion. What else do you want? Okay, now the question is, how much of this $90 billion is excess due to the COVID situation? Well, they were 60, 65, 69, 69. So they were 69 before 2020. Now they're 86. I'm sorry, now they're 90. That's a big jump. That's 20 billion more. And I'm not sure that you can count on that to continue. So when you're looking at FedEx, you really got to go back to 2019 and look at the profit you had here. So if we ignore, that's good. They made money even in 2020. Don't know why 2019 wasn't good. Haven't researched it yet. 2018, 4.5, 3 billion. So you figure they're good for at least 3 billion, $4 billion, and that this money might be bonus money. But 3 billion, 4 billion, it's 20 times earnings. It's a comfortable spot for Federal Express. So it's fine for a long-term play. And if you look at them over 5 years, you go back 5 years, they're really almost at the same price they were 5 years ago. And you look over here and you look at the long-term chart and you say, where were they? They were 100 and 150, 160, 170. So we could see 200, because this is going way back to 2007, 2006. And they dipped down at the time to 50. They recovered back to 100 here. But this is back in 2013, and they were doing 50 billion here. They're not going back to that. They're solid to be 50% higher than that, and 50% higher than that would be 150, 175, 180 range. So they're at the right price now, 220. And when I say they're at the right price now, it means that we can construct a play where we play these guys bullishly. And this is what's great, when the 2024s are out, you have so much leeway to construct something using the options. So for FedEx, you say, well, how much did we say we don't mind? We said 170, 180 is fine. So again, look at these prices. So we could sell we can probably sell the 150 puts. I think that's too low though. I think probably it's 170. Sell the 170 puts for 15, 16 bucks. So your net entry is, if you do that, is 155. So that's like free. Okay, so if you sell those and you collect the money, you're collecting 10% of the total price. So even if you're in an IRA account, that's not bad, although it is over 2 years, but you're still making 5% a year for doing nothing. If you have a margin account, the margin requirement is going to be very small on this thing. Let's say sell single. So the buying power effect of selling 10 of these things for $15,000, and that's actually on the low end, but let's, whatever. So if you sell 10 of these things for $15,000, it only requires $10,000 of buying power. Because it's so far out of the money. Now, the problem is, though, if FedEx dips a lot, the buying power requirement, the margin requirement, will go up. Because right now it's 20% out of the money. And something 20% out of the money doesn't require a lot of margin. But if it gets closer, it will require the margin. So you still have to really, really be willing to buy the shares. But let's say we do 5, and all we would end up doing, we'd buy 500 shares for $170, right? So 500 times 170 is $85,000. So if you have a portfolio big enough, like the long-term portfolio is, and you could afford to own $85,000 worth of FedEx. Now, how much are we risking, by the way, in this scenario? Do you think FedEx is going to go to zero? No, that'd be stupid, right? So you're not risking $85,000. You're risking what you think you can lose. So if I think FedEx might lose half of 170 and go down to $85, which would be, unimaginable how it could possibly do so poorly. But if it went all the way down to $85, you would be out $40,000. So that becomes your risk. So your risk on the play is $45,000. Your reward is $15,000, $16,000 for what you sell the puts for. Oh, I'm sorry, we'd only be selling 5. No, that's if you sell. No, 5. I said 500. So if you sell 5, you're only going to collect $7,000. Your reward potential is $7,000. Your risk is $40,000. But then you take that $7,000 that you collect, or whatever it works out to, $7,000, $8,000, and then you construct a spread. And I say, well, okay, what spread can I set up? Well, I could buy, I can top out at 200, but I don't really think 220 is a fair enough price. So let's say we top out at 220 and we get $40 for the 220 calls. Probably not, probably 38. And then we go down and say, well, what's 58? I guess probably, well, for sure we can get the 185s. Now, what if instead we did the 200? So the 185 220s is a $35 spread. Or if I sell the 200s for 48, then I want to look at what's going to be, let's say 48. So I could do the 170 200s, and the 170 200s would be 48 minus 66. So that's going to be $22, right? No, I'm sorry, no, less. So it's $18. So that's $18 for that spread for 170 200, or I could do the 220s for 38 and the 180s for 60, and that's going to be $22. So I think I'm ready to do the other one. All right, so that's settled. So we're going to sell the 200. So we sell the 200s for 48. We buy the 170s for 66, and that's $18, right? Yeah. So that's $18 on that spread. So if we buy 10 of those for $18,000, we're in the 170 200 spread, and then we sold these guys for I'm sorry, for 16, so $8,000. We collect $8,000 selling 5 of these puts, the 170 puts. We spent $18,000 on the spread. So now then we spend net $10,000 on the $30,000 spread, on the 170 $200 spread. But the 170 $200 spread is entirely in the money. Unless FedEx drops 10% over the next 2 years, we're going to collect $30,000 and make 200% playing FedEx. That's how you construct an options play. Unless FedEx is below $200, we're going to make 200% on our $10,000. We're going to make $20,000. Even if FedEx drops 20%, right? So FedEx goes from a 222 times 0.8 to 177. At 177, it still doesn't trigger the short puts. So our net is still $10,000. And then we would collect, obviously, 177, we collect 7,000 back. So we'd lose $3,000. So if FedEx drops 20%, we lose $3,000. We aren't really in trouble unless FedEx is at least 25% lower, unless it goes below 170. We don't really hit big trouble. And of course, obviously, we would roll and we would adjust. So now we start thinking about the trade and say, wow, it's really hard to get in trouble here, right? Because let's say that we currently had, let's say January, and let's say we had done that at 250. Not 250, out of the money. So let's say we had done the 220s. And let's say we had sold the 220 puts. That's this January. So let's say we had sold the 220 puts for the same 18 bucks. So they would now be 12, even though we're at the money. So they're still 12 because we made some money from it. And we're not, and if we waited till January, they'd be 0 if we stay at this price. And but then the 220 250 spread, because again, we're saying it would be the same $30 spread. The 250 230 spread was 15, and 250s are 4. So that would be 15 minus 4 is 10 bucks. So the spread would be the same $10 we had. In other words, I'm just assuming that we had done the same thing 2 years ago, right? So the spread would be the same $10 net that we started with, and we would have made money on the puts. So on the whole, we'd be no worse off. We'd be we would then, but what would we do? We'd then roll the puts to a much lower strike in 2024. We'd stick with the puts. We wouldn't pay them back. We'd roll out to a 2024 price. And by the way, at the 220s are 13 bucks. And in 2024, 13 bucks puts us into the 160s. So we could roll them all the way out to the 160 puts and cash in the calls, and then just leave the put play on and say, oh, well, the long spread didn't work out and we're done with that, but now we're in net zero. Now we're in for the short put play, and we got our $10,000 back off the table. So you have to think ahead like that to what your downside would be. So in other words, doing the 170 short puts 5 and buying the 170-200 spread, we have the upside potential. Scenario 1, it stays over 200. In scenario 1, we make $20,000. In scenario 2, we flatline at 220. Well, we still make we would still be at $22,000 because we have the not flatline. If it goes down 10%, we still make our money. If it goes down 20%, we get our money back. So it has to go down 25%. Now, what happens if it goes down 25% or more? Well, if it goes down 25%, we're at 170 and we're into the scenario that we just went over. So 25% down, we would recover a good portion of our money on the bull call spread. At some point, we would give up on it and take it and either move it or whatever. And we can roll the puts down to probably like the 140 puts going out 2 years. And so the question now becomes, am I willing to own 500 shares of FedEx at 140 for $70,000? Well, currently 500 shares of FedEx is 222 is $110,000. So am I willing to own 500 shares of FedEx for a $40 discount? I'm sorry, $70 would be a lot more than 40. 140 would be a lot cheaper than that. Be an $80 discount. Yeah, so basically a 30% discount. So am I willing to own FedEx for a 30% discount 2 years from now, 500 shares? That's what the question is. And if I'm willing to own that and that fits in my portfolio, and again, we can adjust it further from there, but let's just assume that's what happens. I don't think FedEx is ever going to go bankrupt. I don't consider it a risky trade. That's how it ends up going in the long-term portfolio. I don't think that's risky. I can't see how that's a bad idea to own FedEx at net 140. And I'm not doing 140 now. There's not 140 doesn't enter into it, but I'm thinking ahead to 2026 where I'll roll. And frankly, if that doesn't work out, by the time you're into 2028, and if I have to roll again to the 110s, I'll be very happy to double down at that point and take a major position, because at that point I would certainly be saying this is ridiculous. It's 50% off the current price. I just can't imagine what is going to happen. How is FedEx going to lose all of its market share? If you can't envision a stock going lower than a certain price, and you can see how you can easily roll to that level, and you can afford the commitment. That's key, though. If you can't afford the commitment, you can't follow through on this plan. But if you can follow through on the plan, if you don't mind committing, if you see this price on FedEx and you go, oh, I think I'm going to get it. I think I'm actually going to get it for this price. I think I'd be like 170. I'd be like, oh, great, 170. Let's take a bigger position. But I know for sure at 140 or 110, I'm going to want to take a bigger position. Can't even imagine what would cause me to be even concerned at those levels. Now, can it happen? Of course it can happen, because the market could easily drop 40% from where it is now. And that's why you have to be willing and able. Willing for sure. Able, got to watch that. Do not overcommit. We have these commitments. We sell these puts. You have to be very cognizant of what you're committing to. Now, in the short-term portfolio, oh, there's a short-term portfolio. I don't know if that's up to date. It's down 43%. Oh, now it's down 46%. So there you go. All right, so in the short-term portfolio, we have $106,000 currently. We have spreads that'll add $200,000-300,000 pretty quickly if the market turns down. That then becomes additional cash we spend to do things like buying Federal Express and stuff. We also, of course, have the cash in the long-term portfolio. La-da-da. See, the long-term portfolio is up 300%. The short-term portfolio is up 50%, but the long-term portfolio is $2 million, and the short-term portfolio is $100,000. So we don't mind at all that the short-term portfolio is down 50%. It's protecting the long-term portfolio. But so is this. So is $1.7 million in cash. And we have obligations. We have these short puts. We are going to buy Apple for 140, I'm sorry, for 105 minus 7 for $98. We are going to buy AAWW for 65 minus 6. We're going to buy BCS for 10 minus 210 for $7. That's interesting. We're going to buy CIM for 15. It's at 15 now. We're going to buy it for 15 minus 3 is 12. You know, these are the commitments we've made, and we're going to buy 1,000, 1,000, 2,000, 2,000. But these are not big commitments. Notice that we threw out our expensive stocks because we were worried about the market. We threw out most of our expensive stocks. Oh, Yeti's doing good. It's the most expensive. The most expensive one we have is Yeti. That's one of the. Oh, here's what's this? Micron. Not worried about them. Holy crap! See, we sold the $60 puts for $5 for our 55 net entry. It's at 69 now, and we're actually losing 20. We're losing money on that, but we're not worried about it. I'd love to own Micron for $55. We sold the $60 put. The worst thing that can happen is we own it for $55. And that's the point, though. See, these things, you know, things are going to go up and down. You know, don't forget there's a chip shortage and stuff. So things are going to go up and down, and Micron's sold off significantly because of all the chip shortages and all the bullshit that goes on. But we would be thrilled to own them for $55, and we would construct a bigger play out of it. That's the key to all these positions, and that's where most of these positions here started out being a short put, and then we said, oh, let's turn that into a bigger play. Oh, look at that. Here's Facebook. We must be getting killed on Facebook. Oh, no, we're not, because we're so far in the money. Huh. Really paying attention to those guys. Facebook. Oh, look at that. So in other words, and all these positions also have puts, so they still have puts. So we have these commitments as well. Wheaton Precious Metals will buy 1,000 at 40 minus 9, which is 30 something dollars. Viacom, we will buy 3,000 shares at 30 minus 13. Holy crap. Holy crap, that's still a great, oh my God. You can sell the $30 puts of Viacom for $11. And the stock's at 38. So the stock's almost at 40 bucks. You can sell the $30, oh, that's a call. I'm sorry, those aren't puts. That I was gonna say, that makes no sense. The $40 puts, there you go. You can sell the $40 puts for $7.25, and that's our commitment, is to buy 1,000 shares of Viacom, 40 bucks minus, well, we sold it for $12.30. It's still $7.25. These are crazy numbers. But so for us, we would be netting in at 40 minus 12 is 28, right? So we would net into Viacom for 28. Do I have a problem with owning Viacom at 28? No, not at all. So I don't consider it an issue. Trox, 20 minus 5 is 15. The stock's at 24. AT&T, 2,500 shares at 28 minus 3 is 25. Well, the stock's at 27. I don't mind owning it at 25. I'm happy to own it at 25 and start collecting dividends. That's how the portfolio works. But the problem now, the thing is, though, you have to add these numbers up and you have to say, well, how much dollars amount am I committing to here? And am I comfortable with that? How much of this 1.7 would have to convert into shares? And the answer is about half of it. But we'd also be getting assistance from the short-term portfolio, because if all these things went to crap and all these stocks fell below the put prices, that would mean the short-term portfolio is paying off and we'd have another few $100,000 there. So instead of using half our cash, we'd probably use about a third of our cash, and that we're very comfortable with. So we'd still have a bunch of cash on the sidelines, and we'd have a lot of stocks that we bought for very cheap prices. So that's what it's all about. I mean, that's what we have positioned ourselves for, to take advantage of a catastrophe. And we did this back in August when everything looked great. And that's why we're so happy now. That's why we're actually thrilled with what's going on in the market. Pullback's fine for us because we wanted to pull back. We got ready to deploy capital. We cashed in our winners and we got ready. All the stocks we thought were stupidly high, we cashed out. And that leaves us with a ton of cash and then stocks that we would really love to own if they get cheaper. So if the market crashes, our new long-term portfolio is going to look like this. We'll be converting these into full positions, and we'll be expanding. These are our favorite stocks that we have left. And so there's 20 stocks here, and maybe some will kill. 25 stocks. There's 25 stocks here, and maybe some will give up on, and maybe some we won't. And we're also going to see how earnings go and how well they weather the storm and how these guys are dealing with inflation and so on and so forth. We'll get more information, and maybe we'll cut a few more. But we got plenty of cash. We have plenty of profit. Of course, it started out as a $500,000 portfolio, so we have plenty of profit, and we're just playing with house money on all this stuff. So it's very easy to move forward like this, and it's a great mellow system for building wealth. But very boring times like this because we're sort of waiting. We just have to wait and see what happens. Clay says he lost about 3 or 4 minutes of my talking. It went on and off at 140. I don't know about that. Hopefully hasn't had problems since. McConnell is talking about, McConnell's talking about raising the debt limit. Aha. Okay, when did Brian say that? So 145, Brian said that McConnell was talking about raising the debt limit. Oh, and look at the reaction. Holy cow. YM. Now, we don't think, we weren't counting on the debt limit not being raised. That'd be monumentally stupid. But we are back to green now. The Dow's up 7, not much, to 17 points, 7 points on the S&P, 60 points on the NASDAQ is a decent amount. And the Russell is still short. So we're making recovery, but you got to just keep it in perspective because it's only based on the short-term thing. And on the whole, we're still doing this. So, you know, it's the same 43.50. Let's see what happens. But you know, I'm sure some people thought the government was going to shut down, but certainly we weren't operating under that premise. They were going to let the whole thing collapse. Maybe it would have been down for a couple of days or a week while they do the Brinksman thing or whatever. But that's, again, like I said, what I care about is stimulus, and I assume they're going to pass the 1.1 trillion, and they're going to pass the 3.5 trillion. I assume those are going to pass. We don't assume they're not going to pass. If they don't, that's going to have a very detrimental effect on GDP. I wasn't talking about the debt ceiling, because obviously if we think those are going to pass, how are you going to pass them if you can't raise the debt ceiling? So it doesn't change anything. It just changes today's basic market trend. People are going to stop reacting to it. And that's the other thing we look at, is we look at the SPY and see what kind of volume is on the SPY. That's always a good indicator. And what we determined last time was that 120 million is about the most that once the volume goes over 120 million, and we're nowhere near it, that's when you start getting downward pressure, because there's not that much automatic buying going on in the market. So 120 is kind of the breaking point. We've had very low volume days, and we're certainly not impressing anyone. We were at 433 on Monday morning, and we're at 433 now. So we've gone nowhere for the week. So all this is a big nowhere at the moment. And we'll see what happens. That's all. We'll just have to pay attention and find out what goes on. Anyway, very, very happy with these positions, though. Everything is good. Oh, these are great companies. A lot of stuff has gone red since last time we looked at it, right? There was only a couple of reds last time. Now we've got most significantly down is Micron, like I said, and I love Micron at this price, so who cares? Vail is a minor, but even Vail is $15, right? Minus 2 is 12. So we're in net 12, and they're at 14. So this is a great entry, which means that I like these puts more now than I did then. So for 445, if you sell the $15 puts for 445, your net is $10.55 for an entry. So who doesn't want that? The stock's at 14. You can enter it for net 10.55. And again, it's 2,000 shares times $15 is $30,000. We don't care if we get assigned 30,000 shares of Vail for, well, it wouldn't even be that. It'd be $12. It'd be net 12. So for $24,000, we would be into Vail for 2,000 shares. And from that, we would build a position. But the reality is we wouldn't do that. We would roll it to a longer put. In fact, right now, I'll tell you the, what do we say, 445? What did I just do? So what's 445 in 2012? Oh, you can't tell, it's so wide. So probably, so we're in the 15 puts now. We could probably roll down to the 13 puts, or we could roll down to 20 of these, of the $10 puts. And let's say we roll down to 20 of the $10 puts and sold those for $2 each, and we'd have a basically even roll. Then where would we be? Then we would have 40 short. We'd have 40 short puts at $10 that we sold for half, right? Because we doubled. So we would have sold them for net 150 each. And then our net would be 850. So in other words, if they'll drop significantly and we roll and double down to the 2024 $10 puts, we will have sold them effectively for net 150, and our net entry would be 850 on 4,000, and 850 on 4,000. So that's 850 times 4,000 is 34,000. So currently we have a $24,000 obligation to buy 2,000 shares. But if it went lower, absolutely increase it to a $34,000 obligation to buy 4,000 shares. Because I would love to have 4,000 shares for only $10,000 more dollars. And that's what I mean. And that's again, if you're really thinking about your sideline money, that's how you have to think about it. So I have to say to myself, well, for Vail, I need $10,000 of this 1.7 million in order to bump my position up. And that's how you have to look at all your positions. You have to look at them one by one and say, would I do this? What would I do? And if you don't like the outcome of what you would have to do if it went lower, then you got to start saying, well, maybe I need to cut this position. That's when you red flag it and say, oh, maybe I don't want to stick with this thing. But the key with these puts is you have to not care about it being, it's 48% off. We're down 48% from where we went in. But we're not down anything because we sold the $15 puts for $3. We net in for 12. It's not below 12. I don't care what that says. Anything over 12 is a winner for us. It is currently a loser. It's currently showing us a $2,900 loss. And we only collected $6,000. We're down almost 50% on that position. But so what? That's not how you measure the performance of your puts, but it only works if you really want to buy the position that you sell the put in. If you were just pretending, then you end up panicking out at a point like this and say, oh my God, down 50%, I got to cut my losses. What losses? How can I have a loss when I wanted to buy Vail for 12 bucks? It's only at 14. I haven't even gotten what I wanted yet out of the position. There's no loss. That was my plan, was to buy it for 12 bucks. If your only plan is to make the money you do selling the put, then your plan can get blown up. But if your plan is to actually own it, it can't get blown up. That's the key to being a long-term investor. That's the key to doing it fundamentally. But again, that's why we're so picky. I don't want to get involved in high-flying stocks. I don't want to get involved in stocks that have ridiculous multiples. I want to get involved in stocks that have a solid business. And we'll go back to Vail. Let's take a look at Vail, in case anybody forgot why we're in it in the first place. So Vail, $67 billion. Well, this can't be dollars. What is this? No, that's Brazilian things. Oh, well, there's no way we'll tell. I'm not going to do the math, but they make plenty of money, put it that way. You know, they're making an unusual amount of money this year because of super high copper prices and stuff, but they will continue to make quite a lot of money, much more money than they've made in the past. And if you go back, so whatever you call these are reals. So, you know, however many reals this is, they used to make 25,000, 20,000 reals. Now they're making, now last year they made 25,000 reals. So that's as good as they did in a normal year last year. This year, ridiculous, can't count that. It'll ease off. But the bottom line is they've always been at this price. They've always been a $10, $12, $13 stock. And so they've always been a $10, $12, $13 stock, but now they make double, triple the amount of money. So logically, they're probably in good shape. They're probably well undervalued. So that's why we got into it. Did we get in, and did we get in with a big position? No, of course not. We have a $2 million portfolio here, and we said we'd buy $24,000 worth of it. It isn't like we bet the farm on it. But we're certainly not getting out of it because we're down 3,000 bucks. That's it's a trivial thing in the portfolio, and it's another very important thing, though. I mean, if you're playing with a smaller portfolio, you just do things in position. If you have a $200,000 portfolio, then you sell 2 of these. It does the same thing. You're going to make the same percentage or lose the same percentage, but it's in proportion to the portfolio. So keep that in mind also, that there's, you know, when we take a position, that's why I always try to do things in 10s and 20s. You know, 5 is like the lowest I'll go. I don't do 1, 2s, and 3s because it's harder to divide. The point is, if you have a smaller portfolio, if it's appropriate for you, you can just take something and divide it by 10 and take that amount, or divide it by 5, or divide it by 2, whatever it is you have. You just want to do it proportionally to what you actually have in the portfolio. All right. So any more pressing questions? We're going to leave it at that. We'll see how much of a bounce we get out of the market. We're going to be right back in that position. Tomorrow's Thursday. So we got 2 days left in the week, and it's all about the 43.50 line this week. Because here's the daily chart, and if we keep consolidating below this line, right? What are we consolidating for? We're not consolidating for a break up, we're consolidating for a break down. If we keep consolidating that line. Here's the daily chart, here's the weekly, and you see on the weekly, that's what I'm talking about. Because if you're below the line, all you have is a candle that's weakening. And that means you're probably going to get another drop and head down to about 4,200 in the next section. And on a monthly chart, you got this. All right, let's see if we can make that bigger. So on a monthly chart, you got this. There's nothing impressive about that. That's why you can't get lost in the short-term charts. You got to think about what these things actually look like. This is a bad week, flattish week, very bad week, and another down week. So far, this is another down week. And if we stay below 43.50, we finish in another down week. That's not good. You might think this looks pretty. You're like, ooh, look, but it doesn't matter. It's irrelevant. And that's kind of the point of the 5% rule. And the point of the 5% rule is to teach you not to pay attention to that stuff. It's all noise. So I think I did it Monday. Did I put up the numbers Monday? Monday. Nope. Wasn't Monday. Tuesday. I know at some point we put the bounce lines up. Nope. Jesus. Oh, well. Must have been last week then. Let's see. Funny, I remember doing it. I feel like it was only like this week, but it wasn't. Here's Monday. Here's GDP Thursday. Wednesday. I don't frickin' know. All right, I give up. So somewhere anyway, we have the bounce lines. I don't remember where the hell they are. And the point is though that's these, we're watching the lines. We have that chart for the S&P, so we can at least see what it is on the S&P. And here's the 43.50 line. Let's 43.50 line. We're consolidating for a move down to here. First we're going to stop around 42, and where we had upside consolidation at 42. That means that's going to be very good support, 42.30 in fact. So 42.30, we should have some pretty good support. But then if we consolidate in the lower half of this range over here, we're probably going to be moving down to this level, to the next stage down, and we'll get support from the 200-day moving average. But if that breaks down all the way to 37.50 is the next goal, all the way down to this blue line. That's the next solid support once we break here. And how much is 37.50? You can see it's pretty symmetrically down below from where the 50-day moving average is up, the 200-day moving average is down. And that's your trading range, right? Your trading range is up and down the S&P. This is not your trading range. This has been over, but we've been over the trading range for so long, we start thinking that's normal, but it's not. The trading range is usually up and down around the 200-day moving average, not up and down around the number, a number that's 10% higher than the 200-day moving average. That's not normal. But patience is the watchword, guys, okay? Earnings start not so much next week, kind of the week after. There's not too many earnings next week, but it really gets, by the middle of the month, we'll have plenty of earnings to look at. And what we care about is not so much earnings, because third quarter was pretty good, it's guidance. How many people are hurting from inflation? How many people are worried about inflation? How many people are worried about the fourth quarter not being as good as they thought it was going to be? If we start seeing a lot of guide downs, we start seeing a lot of warnings about inflation, that's going to deeply affect the way we're going to be looking at the market. We're going to be a lot more cautious. If the companies seem to not be too worried about it, if they think that the consumers are they're passing on the prices and things are looking good and so on and so forth, and the supply chain's improving, then great, we better start buying things while they're cheap. But as you can see, you know, FedEx and whatever, there's plenty of things to buy. There's plenty of things to add to our portfolio, and it's not like our portfolio is empty. So, I mean, what are we going to do? Buy 25 more positions? No, we got tons of positions. We're not in a hurry. We're not panicking, and we are currently fairly bearish because the short-term portfolio is set up very bearish. But the long-term portfolio is very cashy, so it doesn't need a lot of protection. The short-term portfolio is very bearish aggressively, but we're only risking $100,000 of losses in the short-term portfolio. We're not too worried about that either. So it's very easy for us to get bullish if we want to. But what we need to do right now is just be patient for another couple of weeks, and then we can start bargain hunting again if the situation presents itself. If not, we're going to have to ride out the winter. If it's going to be as bad, if the fourth quarter looks bad, we're going to have to ride it out and wait till January. All right, so everybody be careful out there. Be mindful of the problems. Keep an eye on China, and we will do this again next week. Thank you, everybody, for coming. Unless there's a last question. Nope, everybody's happy, and McConnell seems happy, and we'll be all fine. Thanks, guys.